Good morning, everyone. My name is Cameron Byrne. I'm the General Manager of Partnerships and Memberships here at the AFA. I'm excited to introduce you to today's webinar, End of Financial Year Strategies, brought to you in partnership with Padua Solutions. Padua Solutions are a software and paraplanning services provider. With the end of the financial year fast approaching, now is the best time to take action. Today's session will look at the opportunities available before financial year end and upcoming changes for the new financial year. I would like to introduce you to our presenter today, Rudy Haddad, Head of Technical Advice at Padua Solutions. For those of you that don't know Rudy has over 23 years of experience in financial advice and product. He is currently the Head of Technical Advice at Padua Solutions, a thriving financial software and services business. Rudy oversees Padua's technical advice capabilities for its software and has key inputs into its successful paraplanning operations. Prior to joining Padua, Rudy was a key person and responsible manager of the Wealth Market AFSL. There, his day-to-day duties included general management, establishing licensee standards, as well as advisor training and quality assurance. Rudy has also held senior positions at ING Australia, OnePath, and ANZ Wealth, including heading up the technical services and intermediated life risk sales strategy. Further, Rudy has worked on behalf of industry and lobby groups to lobby the Australian government on areas impacting advice, product design, superannuation, and taxation law. Before we begin, I'd just like to cover off some housekeeping. CPD is available for this session. The AFA will send details out within the next week. As a webinar attendee, you will remain on mute throughout the session. Questions will be answered at the end of the presentation. Please use the Q&A function, not the chat function within the Zoom video capability. I will now hand over to Rudy. Thanks very much, Rudy.
Thank you, Cam, and thanks to the AFA for this wonderful opportunity. I'd like to also thank you for taking the time out of your busy schedules to tune in this morning. Just some important notes before we kick things off. The contents of this presentation is not intended to be personal financial product advice, so please keep that in mind. And also, we've done our best to interpret legislation as best we can, and Padua does not guarantee the outcomes of that research. Now, without further ado, I'm going to start the presentation. We'll be spending most of our time on the superannuation portion of the presentation. And towards the back end, we'll spend a couple of minutes on some personal taxation strategies you may wish to consider for your clients. I want to begin by talking about some of the exciting upcoming superannuation opportunities. Now, these come into effect on 1 July 22. So at present, there may be circumstances where your clients don't qualify for certain strategies in the lead up to financial year end, and they will be qualifying for such strategies at the start of the next financial year. Namely, we're talking about the removal of the work test and the opportunities that delivers. So at present, if you're age 67 plus, broadly speaking, you must meet a work test in order to make non-concessional or concessional contributions. That changes from 1 July, at least in respect of your non-concessional contributions and your salary sacrifice type of contributions. So that 40 hours over 30 consecutive days is no longer a requirement for non-concessional contributions and your salary sacrifice contributions. Having said that, as you know, in order to salary sacrifice, you still need to be working, but you don't need to meet the 40 hours over 30 consecutive days. You'll notice that there is still the work test being retained for personal deductible contributions, so please keep that in mind. But absolutely opens up a lot of opportunity for your older clients who are under age 75 looking to make non-concessional contributions. So stay tuned, that starts on 1 July 22. Also, extending the non-concessional contribution bring forward trigger age. So at present, on this side of the end of the financial year, you need to be under 67 in order to trigger the bring forward rules. That's the 2-year bring forward or the 3-year bring forward. That changes from 1 July 22. So under the new rules, what's coming is, so long as you are under 75, when you make that non-concessional contribution, you are able to trigger a 2 or a 3-year bring forward period, which is great news. And if you couple that provision with the one we just discussed above, the removal of the work test, it becomes a really powerful financial planning tool for you to deliver to your retiree clients who are in that 67 to 75 age bracket. You'll be able to trigger the bring forward rules for non-concessional contributions without meeting the work test, which is great news. Also, we have downsizer contribution changes. What's changed in this area is that the minimum qualifying age will move from age 65, which is the present qualifying age, to age 60 from 1 July 22. So again, it's opening up more and more opportunities for your clients. Just bear in mind that the downsizer contribution is not a non-concessional contribution. It does not count towards the non-concessional contribution cap. Again, if you couple it with the strategies above, you'll be able to deliver some sizable contribution strategies for your retiree clients as well. And worth noting that there is no upper age limit for your downsizer contributions there. So even clients who are over age 75 may qualify. Now let's change focus to look at some financial year-end strategies. On the left-hand side, you'll see a number of those traditional strategies summarized there. But on the right-hand side, at the top there, you will see a reference to TSB, or total superannuation balance. I want you to disregard what's on the left for a moment and focus with me on what's sitting there on the right of that table. The TSB, or the total superannuation balance. Now, this is not to be confused with the transfer balance cap, or the TBC. They are two separate measures calculated in two different ways, and they serve two distinct purposes. So the transfer balance cap, by contrast, determines how much one could transfer into a tax-exempt retirement phase pension. The total super balance will determine the eligibility to any one of those strategies listed on the left-hand side. Now, when you're dealing with the total super balance, you're always looking at it in arrears. So what do I mean by that? Essentially, what we do is, if you are looking to implement one of these strategies this financial year, your reference point is the total super balance as at 30 June of the last ending financial year. So you're always looking back one financial year and you're grabbing that 30 June total super balance. Now, if we step through some of these strategies on the left, yes, you may be able to trigger a 3-year bring forward for your clients. We'll discuss some of the rules around when you can trigger a 3-year bring forward. But as you can see on the right-hand side, you need to have a total super balance of less than 1.48 million. If your total super balance is above 1.48 million, but below 1.59, then you are restricted to a maximum 2-year bring forward. Okay, so not all bring forward arrangements are 3 years in length. So please be mindful of that. Now, irrespective of whether or not your client has already triggered a bring forward period, if they have some room left under that bring forward arrangement to contribute more and to top up, they'll only be able to make that non-concessional contribution if their total super balance, as at 30 June 21, is below 1.7 million. So regardless of whether or not you've used up the full bring forward cap space, even if you haven't, if your total super balance exceeds 1.7 million, you will not be able to make that top up contribution. So again, please keep that in mind. The same goes for government co-contribution. It's a great time of year to deliver a 50% co-contribution for your clients. That's obviously capped at $500. It applies for people earning up to $67,000, and they potentially qualify for the full amount if they're earning below $51,000 there. Again, in order to qualify, you need to meet certain criteria, one of which is a total super balance below 1.7 million. Moving on, the spouse contributions tax offset. If you are looking at making an NCC contribution for your spouse, consider whether or not the spouse contribution option is better than the personal contribution option. You may be recommending a bit of both. So the personal contribution might be to qualify for a government co-contribution, and the spouse contribution up to $3,000 could qualify for an 18% tax offset to the spouse making the contribution. Okay, so 18% of $3,000 could yield a maximum spouse contribution tax offset of $540. Again, you'll see the reference to total super balance. So you must have a total super balance for the receiving spouse below 1.7 million. Now, one of the most exciting changes that were introduced in 2017 was the ability to carry forward unused concessional cap amounts. You can carry forward up to 5 years. I'll explain what up to 5 years means in a moment, but it is up to 5 years in which you can carry forward. Now, you can only utilize previously unused concessional contribution cap amounts if your total super balance, that is as at the preceding 30 June, is below 500,000. If it is above 500,000 and you make a large concessional contribution, that is a contribution above the annual cap, you will end up triggering excess concessional contributions tax for your clients, which you don't want to do. So please be careful of that. We really need to understand what the client's total super balance is before we recommend such strategies. And then we have the work test. So this work test applies from 67 to 74. It's an exemption from the work test rather in the year following retirement. And basically what this means is if you have a small superannuation balance, you can see that's defined as less than 300,000 total super balance, and you met the work test last financial year, then you are able to make a contribution into super without meeting the work test in the current financial year. So that's a little exemption there for you, and it only relates to small balances. So we talked about the total super balance and its importance. So what is it? How is it calculated? I don't want you to focus on the stuff that's highlighted in the light gray. Just focus on the darker text for a moment. In its simplest form, and I'll stress, in its simplest form, the total super balance is the value of superannuation accumulation accounts, TTR pensions, and account-based pensions, right? As at 30 June. Now, in some cases, there might be a rollover in transit, so it hasn't landed in a superannuation account on 30 June. The ATO will also count that in to determine the total super balance. As I indicated, that is it in its simplest form. Now, unfortunately, we don't live in a simple world, and things can get very complicated with this calculation if you throw in a defined benefit or an SMSF, or if your client has moved from one account-based pension to another. Okay, so the formula can get pretty complicated. And that's why we'd love for you to go to the source, which is the ATO, to determine what the total super balance is and what other metrics are, before you give your financial planning advice to your clients. Now, this is a screenshot from MyGov. In particular, it's the ATO portal in MyGov. Most of your clients will have access to this. If they don't, perhaps you can help them set the access up. Unfortunately, as financial planners, unless you are a qualified tax accountant, you don't have access to your client's portal. You can't go in there and freely look up this information. So you're relying on your client to go in there and pass this information on to you. If your client is perhaps a bit challenged when it comes to navigating this type of portal, you may assist them whilst they're in the office with you, or you might sort of do some type of remote conference where you can look at what they're doing on the screen. Just be careful that you do not cite the passwords of these type of accounts, because you really shouldn't be doing that. But there are other ways around it, as I've outlined. You can also contact the ATO on 131020 in your client's presence, or if you have authority from your client, and you can get the information that way. But as you can see here on this menu, there's a lot of powerful information that you can get from looking at this portal. It's sort of real-time data in some ways. If there's a defined benefit fund or an SMSF, then there might be some considerable lags, because those type of funds have more time to report transactions to the ATO. Okay, but once again, please go to the ATO, have a look at the information they've captured, make sure you reconcile any lags, particularly if there are defined benefits and self-managed super funds. Now, we've discussed a lot already. Let's put some of this into practice with a case study. We have John, who's 65. He is retired. He's just sold an investment property in the current financial year. So he's got a lot of money. That's 900,000 off the back of that. 400,000 is the capital gain. Let's assume, for simplicity, no carried forward income or capital losses. Now, what do we know about John? His current superannuation balance is 600,000. He has not made contributions in the past few years. And his total super balance as at 30 June 21 is 490,000. So if you look at what's on the screen here, his current super balance is 600,000, but his total super balance at the end of the prior financial year is 490,000. So let's ask ourselves, if he wishes to maximize the NCCs and the concessional contributions, how much can he put in? Under the bring forward rules, if he's looking to trigger the bring forward arrangement, because his total super balance as at 30 June 21 is well below that 1.48 million, he is able to trigger a 3-year bring forward arrangement. So he can put in 330,000, which is great. Had his total super balance been higher, then he may have been restricted to a 2-year bring forward, or potentially no bring forward at all. And in the worst case scenario, if his total super balance was above 1.7 million, that's the balance at 30 June 21, then he would not have been able to make a non-concessional contribution. Great news, however, he is able to trigger a 3-year bring forward. Importantly, if you have clients who are already in a bring forward arrangement, so you have triggered a bring forward last year or the year before, or potentially this financial year, you've contributed more than the annual cap of 110,000, then you would have triggered a bring forward arrangement. Importantly, the amount that you can contribute within that bring forward period, the maximum amount, is always a multiple of the annual NCC cap in the year in which the bring forward was triggered. So if you look at a 3-year bring forward, which is the bottom table, and assume that we are dealing with a client who triggered the bring forward arrangement in 2020-21, that is last financial year. The annual NCC cap last financial year was $100,000. We have had an indexation of that cap for this financial year, but for last year it was $100,000. Being a 3-year bring forward, we multiply out 3 times 100,000. So the maximum that can be made as an NCC in that bring forward period is 300,000. Please do not, in those instances, think that the client has received the benefit of the additional 10,000 per year resulting from indexation of that NCC cap. They do not until they're no longer within the bring forward arrangement. Then they may trigger potentially if they qualify a new bring forward, in which case that multiple will be based on 110,000. So back to our case study. Because John is under 67 currently, he can make a non-concessional contribution without meeting a work test. That's fine. He can put in 330,000 if he likes, or he can put in 110,000 this financial year, and in doing so does not trigger a bring forward. He can then wait until 1 July 22. Doesn't have to meet the work test. That changes to under age 75, work test no longer applying. And he can potentially make a 330 NCC by triggering bring forward. That depends on his total super balance as at 30 June 22. So 30 June 22, total super balance will dictate his ability to make non-concessional contributions and trigger bring forward of those contributions. So please keep that in mind. Now, in terms of personal deductible contributions, can they be made and what is the maximum? Unfortunately, he has triggered a capital gain, so there might be some CGT payable here, but there are some strategies that you can look at for John. Personal deductible contribution is a perfect strategy for this particular situation. So he is 65, meaning he's under age 75, which is great. And he's also under age 67, which means he doesn't need to meet a work test. So in order to make a personal deductible contribution, you first must be under age 75. If you're 67 or over, you then need to meet the work test unless you qualify for that recent retiree exemption and you have less than 300,000 in your account. We spoke about that one earlier. So in this case, John satisfies that requirement. Now he can utilize up to 5 prior financial years of unused cap amounts. Now we say up to, this only took effect from 2018-19, which means he'll be able to utilize the 18-19 unused amounts, 19-20 and 2021, in addition to the current year's 21-22 cap, okay, which will be considerable as we will see in the coming slide. Fortunately, his total super balance as at 30 June 21 was less than $500,000. So he can utilize the carry forward unused amounts. The last bullet point's important. I always get questions from advisors saying, Rudy, does my client have to notify the ATO? They're looking to utilize carry forward unused cap amounts from previous years. The answer is no. They do not need to notify the ATO. The ATO does all the data matching. All your client needs to do is make sure they submit a valid 290-170 tax notice before the deadline. Okay, now we see this go wrong all the time, so I can't stress enough. Make sure there is a valid notice and that notice is acknowledged by the trustee before the deadline. You can't submit a notice and then complete your tax return. You must submit the notice, receive acknowledgement by the trustee for the notice, and then submit your tax return. A couple of things to be mindful of here. The 290-170 notice must be submitted and acknowledged before you withdraw the contributions. Now, we see this again go wrong all the time, particularly if you're rolling over money from one super account to the next, or you're starting a new income stream for your client. going from accumulation to pension phase. If you are recommending such strategies, great. Make sure before you do that, the client submits and receives acknowledgement for the 290-170 tax notice where they are intending on claiming a tax deduction for the contributions. Otherwise, the contribution or the deduction rather will be denied on the basis that the money no longer sits in the account. Now, it'll either be fully denied or in the event of a partial withdrawal, it might be partially denied. So please keep that in mind. Also, in terms of deadline, you have to submit the tax return as well. If you submit the tax return and then you submit your 290-170 tax notice to the trustee, it's too late. So you've got to submit the tax notice before you do the tax return. And lastly, this all has to happen no later than the end of the following financial year in which you made the contribution. So please be mindful of these deadlines. Now back to our case study. We wish to maximize the concessional contributions. The great news is John is under 67, so he can make personal deductible contributions. His total super balance as at 30 June 21 is below 500, which means he can trigger the carry forward of unused amounts. Now you'll notice what I've done here. I've got that he can claim a tax deduction of $27,500. That relates to the 21-22 cap, the concessional contributions cap. So you must use the current year's cap first. That's why I have it in this order. Then if you wish to use unused carry forward amounts, you go to the earliest year. And the earliest year is 1819. So then you use the 25,000 or whatever's left over from that year. Following that, you move to the 1920 and you claim whatever's unused from that year. And then you move on to 2021. So you're always using the current year's cap first before you utilize unused amounts from previous years. And then you go to the earliest of those years and you work through it in that order. Now, the overall tax savings for John doing this, that is claiming $102,500 as a personal deductible contribution, is going to be between $25,000 and $32,800, depending on his marginal tax rate, which is considerable. And this automatically takes into account the 15% contributions tax. Case study 2. So Kathy is 69. She has not worked in the last few years. She has $500,000 in her bank account. Her total super balance as at 30 June is $490,000. Her current balance is $600,000. We don't know what the total super balance will be in June 22. We might, with a degree of confidence, guesstimate that it'll be well below perhaps 1.48 million or 1.7 million, depending on which strategy we're looking at for Kathy. In terms of non-concessional contributions, she's not eligible to contribute this financial year. She does not meet the work test, nor does she meet the requirement to utilize the recent retiree work test exemption for small super balances. Good news is from 2022-23, she can contribute. She's under 75. There is no work test for non-concessional contributions for those under age 75. So she can absolutely contribute. And she can look to do 110,000 next financial year and potentially up to 330,000 in that following financial year to utilize bring forward. So there are a number of options that Kathy may wish to consider, or you as her advisor may wish to consider for her. Unfortunately, concessional contributions not eligible under the current rules, won't be eligible under the new rules, because even though she's under age 75, she does not meet the work test, being 67 plus in age. So you still need to meet a work test, even under the new rules, in order to make personal deductible contributions. One timely contribution strategy is the spouse contribution splitting. This is where you can split up to 85% of concessional contributions with your spouse. Again, you must notify the trustee and receive acknowledgement that they are now aware of that and have updated their systems accordingly before you withdraw those concessional contributions. Also, you must be aware that 30 June of the following financial year is the absolute deadline for that. So please keep those deadlines in mind. The point here is if you're recommending a rollover out of the super fund for your client, maybe to a new super fund or to start a pension, and you are looking at contribution splitting as a strategy, you need to submit and receive acknowledgement of that notice before you proceed with the withdrawals of the contributions. Otherwise, it's too late to split. We're in the home stretch. Personal taxation, not a lot that can be done in this space. A few obvious ones. So you are able to prepay certain expenses and claim the full deduction this side of the financial year. So prepaying income protection premiums up to 12 months and claim the full deduction. Ongoing advice fees relating to producing assessable income is also one that can be claimed. I'm not sure what your AFSL's rules are around that and whether or not you must receive your advice fees on a monthly basis, or if you're allowed to levy the full 12 months in one hit, but that's something you can discuss with your AFSL. And obviously there are things like prepaying interest on an investment loan as well. Charitable donations, that's something that can be considered. I know the AFA has its own foundation. I have a very great colleague of mine who works tirelessly with the guys from the AFA Foundation. And guys, if you can support that or your clients can support that'll be fantastic. And last but not least, the low to middle income tax offset. Now, unfortunately, the government will not be extending this offset beyond this financial year. So it is the last hurrah. It's the last opportunity. Taxable income below 126,000 may entitle you for a part or a full offset. It's up to a maximum of $1,500, and you must submit the tax return in order to qualify for that offset. Guys, I want to thank you for coming along this morning and listening to our presentation. We've covered a lot. If I can leave you with a couple of things, please, when you are giving advice to clients and such advice is impacted by a contribution cap, a threshold like the total super balance, transfer balance cap, a CGT cap, all these caps, the ETP caps, there are so many, whole of income caps, probably about 6 or 7 more. Go to the source, go to the ATO if you can, get that information, and good luck with everything, guys. And thank you. Over to you, Cam.
Thanks, Rudy, for a great session there, as you always deliver over the years. At the moment, there's no Q&As that have come through, so we might just wait 30 seconds just to give people the opportunity to send them through. But in the interim, I'd like to thank you on behalf of the AFA and our members, Rudy, and to Padua Solutions for partnering with us and delivering this end of financial year strategy session. I think you touched on it. It seems to be that as we progress each year, there's less and less you can do to maximize things. But it's really good to hear from an expert such as yourself to give people, that confidence and those ideas if they're up, looking for strategies for end of financial year for clients. So we might just wait another 30 seconds for any Q&As.
No worries at all. Thank you, Cam.
Yep, we've got one that's come through. Couple with the proposed changes with the downsizer contribution, does the 10-year ownership still apply?
Absolutely, it does. Yes. No other changes made to downsizer other than bringing forward that qualifying age to 60.
Another question. I have a client who did a S290-1870 correctly, then rolled out. His MyGov shows the rollout. Did the super trustee make a mistake?
Not necessarily. So I'm not sure if the individual who asked the question could answer this question that I have for them, but has the tax return been submitted for that financial year yet?
I think further to that too, it was a partial rollout, I think, Rudy. Was a reduction to life super sum insured. No, it's for 2022.
Okay, that's it. So what you'll find, and there has been a change in the last 4 or 5 years in the way the ATO accounts for this sort of stuff. So importantly, the 290-170 notice has been sent to the trustee within the deadline and acknowledged by the trustee before the rollover took place. Now, what happens is the trustee will report certain metrics to the ATO. As far as the ATO is concerned, it still puts that in the dashboard as a non-concessional contribution until the tax return for the 22 year is completed. And that's when it then finalizes it. It'll reduce the NCC amount appearing in the portal and will increase the concessional contributions amount then. So there's just a different way in which they account for this, and that came through probably 4 or 5 years ago.
Continuing on from that, he has the acknowledgement for the full amount. Will it be allowed?
If they have acknowledged the full amount, then yes, it will be allowed. The only caveat around that is you cannot claim a couple of caveats. You qualify to make personal deductible contributions. So example, you're under 65, etc. And the other one is you cannot claim a tax deduction to the extent that you are triggering an income tax loss in the year. So if your taxable income is 50,000 and you are using carry forward and things like that, you can't claim the tax deduction to exceed 50,000. You cannot trigger an income loss to carry forward into the next year through this particular measure. But that aside, yes, the full deduction should be allowed. I think it's safe to say.
One more question that's come through. With contribution splitting, does the CC cap for the person receiving the contribution apply?
No, it's the person making the contribution, the person who has received the contribution from their employer, or perhaps made the personal deductible contribution. That is where it counts towards the cap. It's the individual who receives the contribution, not the spouse who's receiving the rollover, right? Because the contribution splitting is a rollover. So no, it does not.
Thanks, Rudy. We had a bit of a rush there with questions. I'll just give people another few seconds and then we might call it a day on your session. Obviously, you've hit the mark with everything you've explained very clearly, so it's really good feedback for that session.
Great, thank you.
Yeah, there's no more questions coming through. So once again, Rudy, on behalf of the AFA and our members, thank you to yourself and Padua Solutions. For those on the webinar today, the webinar recording will be available on our website. You will receive your CPD certificates in the next week or so. If you've got any questions, please reach out to info@afa.asn.au. Once again, thank you for joining us today, and thanks very much, Rudy and Padua Solutions.
Absolute pleasure. Thanks, guys.
Thank you.